If you've been watching the metals market this week, you probably felt the shockwave before you even saw the chart. Silver just ripped nearly 9% higher to around $86 an ounce, and this happened only days after a jaw-dropping 27% single-session collapse. Let that sink in for a second. Billions in value erased, then partially rebuilt almost overnight. I'm telling you right now, this isn't just volatility. This is a live case study in how modern markets break and reset. Stay with me because I'm going to show you what actually caused this whiplash, and more importantly, how you can recognize the next one before it hits headlines. If you're watching this now, you're ahead of the emotional crowd that only reacts after the move is done. Your job is to understand the mechanics before the next wave hits. Before I explain what triggered this rebound, let me teach you something most investors don't fully grasp. Markets don't usually crash because everyone suddenly agrees an asset is worthless. They crash because of mechanics. Plumbing. Pressure inside the system that has nothing to do with your opinion about where price should be. Think of it like a crowded theater where someone yells fire. The danger isn't always the fire itself, it's the exit bottleneck. When too many traders try to get out at once, prices don't slide down gradually. They gap, they disappear, and you're left staring at your screen wondering what just happened. Here's what you need to know about extreme oversold conditions. When an asset drops fast enough, it forces participants to sell regardless of what they actually believe about the asset. Funds hit risk limits. Leveraged traders get margin calls. Algorithms detect momentum and pile on automatically. And suddenly price stops reflecting opinion and starts reflecting survival. Have you ever noticed how the fastest drops often get followed by violent rebounds? That's not optimism returning. That's not new buyers suddenly loving the asset. That's pressure releasing. It's mechanical. And if you understand the mechanism, you can actually anticipate what comes next instead of just reacting to it. So, what does that tell us about the silver move? Everything. If this is making sense so far, drop a comment below and let me know if you saw this rebound coming or if it caught you off guard. Now here's what's actually happening under the surface. Let me break down the sequence so you can spot it next time, because I guarantee you there will be a next time. First came the primary driver, and this is critical: higher futures margin requirements. When exchanges raise margin, traders must post more collateral immediately. There's no debate, no delay, no negotiating. If they can't come up with the cash, their positions get liquidated automatically. So imagine thousands of leveraged players all scrambling for cash at the exact same time. What happens? Selling begets selling. Price falls, which triggers more margin stress, which forces more selling. It's a cascade, a feedback loop that feeds on itself. And here's the thing about cascades. They don't care about fair value. They don't care about your technical analysis. They care about one thing: survival. When you're getting margin calls, you don't sit there analyzing support levels. You hit the sell button and you move on. So that was the initial driver. Margin requirements went up, leverage got squeezed, and forced liquidation started rolling through the system like a wave. But that's only the first layer. There's more happening beneath that. Then came the secondary confirmation, and this is where it gets interesting. Rapid position unwinds from large speculators. These are the big players who'd ridden silver higher, who had massive long positions built up over weeks or months. Suddenly they had to flatten their exposure, not because they changed their thesis about silver, not because they stopped believing in the bull case, but because the math changed. Risk managers don't care about your conviction. They don't care about your 12-month price target. They care about solvency. They care about keeping the fund alive to trade another day. So when volatility explodes and your positions are suddenly threatening the portfolio, you cut, you reduce, you get smaller. And when everyone's doing that at once, you get these violent moves that seem completely disconnected from any news or fundamental change. Now here's where it gets really important. Here's the convergence that matters. Forced liquidation peaked, and when forced sellers disappear from the market, something surprising happens. The market snaps back toward the level where voluntary buyers were actually waiting all along. See, during the panic, real buyers step aside. They're not stupid. They know you don't catch a falling knife. But they're watching, they're waiting, and once the forced selling exhausts itself, once the margin calls stop coming, those buyers step back in. Not at the highs, but at levels they actually find attractive. That's what you just saw. That 9% rip wasn't necessarily new bullish conviction flooding in. It was the absence of panic selling combined with patient buyers finally getting their chance. But here's the part that should make you nervous, and I need you to really hear this. Easing liquidation pressure doesn't automatically mean the bull trend is back. It doesn't mean we're going straight back to the highs. Reflex rallies can be brutal. They're fast. They feel powerful. They lure you in. They feel like validation if you held through the drop. But sometimes they're just the market catching its breath before choosing a real direction. It's like a boxer getting knocked down. He might pop back up quickly. That doesn't mean he's winning the fight. It just means he's still in it. So ask yourself this. Was this rebound new demand, stepping in because they see value, or was it just the absence of panic? That distinction matters more than you might think. This is the exact same playbook we've seen across decades of market stress, and I mean decades. Zoom out, and you'll recognize it immediately. Let me give you some context so you can see this isn't new. During the 1980 silver spike and crash, you had the Hunt brothers trying to corner the market. Silver went parabolic, then collapsed under forced liquidation when margin requirements changed. And what happened next? Sharp countertrend rallies that stunned traders who thought the move was completely over. Price dropped far below any rational equilibrium because of the mechanics, then snapped back violently once the forced selling cleared. Same pattern, different decade. Fast forward to 2008, commodities across the board collapsed under deleveraging pressure during the financial crisis. Oil, copper, silver, everything got destroyed. But what happened once the forced selling cleared? Explosive rebounds, not because fundamentals magically improved overnight, but because the mechanical pressure released and real buyers could finally step in without competing against a wave of forced liquidation. Every time you see this pattern, the larger story is about leverage, unwinding, not fundamentals evaporating. Even the 2020 pandemic panic followed the script. Historic drops across nearly every asset class, liquidity scramble, margin calls, forced selling. Then once central banks stepped in and the system stabilized, you got these surges that felt almost unbelievable if you'd been watching the previous weeks. Same mechanical process playing out. When you look at the pattern across time, you see markets behaving less like voting machines and more like pressure valves. They build pressure, they release it, and the release can be just as violent as the buildup. Now, before we go further, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this surge be misleading? Absolutely. Reflex rallies often fade if real buyers don't step in afterward with sustained demand. Could this be a bull trap that sucks people back in right before another leg down? Yes, it's possible. Could this whole thing be manipulation by big players or central banks or whoever else people like to blame? Maybe. I don't know. You don't know. And here's the thing. It doesn't actually matter whether there's some shadowy force behind the curtain. Blaming manipulation might feel satisfying when you're losing money, but it rarely helps you make better decisions going forward. Focus on what you can actually observe. Liquidity conditions, positioning data, margin trends, participation levels. The data usually whispers the truth long before the narratives start shouting it. If you spend your energy chasing conspiracy theories, you'll miss the mechanical signals that actually predict the next move. Stay focused on the plumbing, not the stories. There are probably 3 types of people watching this right now, and I want to speak to each of you directly, because your situation is different and the lesson you should take is different. First, you might be the dip buyer who saw the crash and thought, this is my moment. This is the opportunity I've been waiting for. I get it. Sharp dislocations can create incredible entries if you time them right. But let me gently challenge you on something. Are you buying because the forced selling actually ended and you see evidence of stabilization? Or are you buying because you assume price must return to the old high just because it was there before? Those are very different bets with very different risk profiles. Don't confuse a reflex rally with a resumption of the trend. Watch whether follow-through demand actually appears over the next several sessions. If volume expands on up days and price holds the gains, okay, maybe you're onto something. But if this rally fades on light volume, you might have just caught a bounce in a larger downtrend. Second, you could be the shaken long who rode the drop all the way down. Maybe you're still holding. Maybe you sold near the bottom and you're kicking yourself watching this bounce. If that's you, I want you to hear this. Volatility is tuition in the markets. It's expensive, it's painful, but it teaches you things that reading articles never will. Instead of asking why this happened to you, ask what the structure of this move taught you about your own risk management. Did you size your position correctly? Did you rely too much on leverage? Did you have a plan for what to do if price moved against you violently? Be honest with yourself, because if you don't extract the lesson, you'll pay the same tuition again next time. Third, maybe you stayed out entirely, and now you're watching this thinking you missed something. Let me reassure you about something. Patience is a position. Sitting in cash while everyone else panics is a skill, not a weakness. Often, the highest probability trades come after the chaos settles, not during the chaos itself. If you stayed out, you preserved capital, and you maintained the emotional clarity to make good decisions. That's worth more than you think. Here's the universal principle that applies to all of you regardless of where you stand. Don't chase emotion, track mechanics. Emotion makes you buy tops and sell bottoms. Mechanics show you where the pressure is building and where it's releasing. If you can separate those two things, you'll be ahead of 90% of participants. So here's what I want you to answer in the comments. Which type are you? Did you buy the dip, hold through the pain, or sit it out? And what's your plan from here? I'm genuinely curious because the variety of perspectives is what makes these discussions valuable. Here's where I stand, and I'm going to be completely transparent with you. I'm not calling this a renewed bull run. I'm also not dismissing it as a dead cat bounce that means nothing. I'm watching closely. Let me tell you what I'm personally watching over the coming sessions and weeks. First, I'm watching whether volume expands on up days. If this rally is real, if it's driven by actual demand and not just short covering or reflex buying, you'll see volume increase as price moves higher. That signals real accumulation, real buyers stepping in with size. If volume stays light or contracts, that's a warning sign that this move doesn't have legs. Second, I'm watching margin policy. If requirements stabilize or come back down, that tells you the forced selling pressure is likely behind us. If they stay elevated or go even higher, you could see another wave of liquidation if price weakens again. Margin is the lever that controls how much mechanical pressure exists in the system. Third, I'm monitoring broader macro risk appetite. Silver doesn't move in isolation. It's connected to real rates, to dollar strength, to overall commodity demand, to risk-on versus risk-off sentiment. If you see equity markets rolling over or the dollar strengthening aggressively, that context matters for where silver goes next. You can't analyze silver in a vacuum and expect to get it right. Based on my analysis, this crash and this rebound were mechanical, not random. They weren't driven by some sudden fundamental shift in supply and demand for physical silver. The deeper fundamentals haven't been rewritten in a week. Industrial demand didn't disappear. Mine supply didn't double. What changed was leverage, margin, and positioning. That's the story. And when the story is mechanical, the resolution is usually mechanical too. If history rhymes and silver can stabilize above the $80 level, hold there for a few sessions, and start building volume on the upside, the move that follows could be significant. I'm not making a prediction. I'm telling you what the pattern would suggest if those conditions develop. I'm not a financial advisor. This is not financial advice. Everything I've shared here is educational analysis, not a recommendation to buy or sell anything. Do your own research. Make your own decisions. This is your money and your responsibility. If you made it this far, you're the kind of person who wants to understand how markets actually work, not just react to headlines. That mentality will serve you well. It separates you from the crowd that buys high and sells low on pure emotion. Keep thinking critically. Keep asking questions. Keep verifying what you see instead of just accepting narratives. If this breakdown helped you see the situation more clearly, do me a favor. Share this video with someone who's trying to make sense of what just happened. Subscribe if you want more real-time market education like this. And stay ahead of the noise by thinking in terms of mechanics, not emotions. Stay sharp out there. Think critically, verify what you see, and make your own decisions.